Good afternoon, everyone.
Good morning, teacher.
Good afternoon, teacher.
It's actually the afternoon. Always so sleepy head. Okay. Okay, please turn on your camera so that we can get started. Okay, so I believe that we stopped at this slide last time. Now, you have spent some time at home to look at this example. Now tell me how you solve this problem. So we look into the same situation as we solved the other day. That we have the spot price of gold, the 1 year forward price of gold, which is the same with the same interest rate. The question here is there an arbitrage opportunity? So your answer to this question is yes or no?
My answer is yes.
Yes.
Yes. Then the reason for that is?
I calculate that equals to 1,400 times 1 plus 5% equals 104,070, which is higher than the 1 year forward price. So the strategy is to short or sell the gold at $1,400. Then invest $1,400 at 5% or 1 year, and enter a long forward contract at $1,400. After 1 year, I will exercise the forward contract and pay $1,400 and receive $1,470 from my investment and close out the short position. So the profit is $70.
$70. Okay. Okay, first of all, if you come across the same thing, the same question, then first of all, we have to answer the question of whether or not there exists an arbitrage opportunity. And our answer is yes, there is an arbitrage opportunity. And in order to answer this question, then we would have to see the price difference between the supposed to grow price from the spot price today that we have, given the interest rate, and we compare it with the 1 year forward price of gold. And if you see any differences, then you can conclude that there exists an arbitrage opportunity. So normally, as you see, we have F, the forward price would be equal to the F could be equal to S0 plus 1 plus multiplied by 1 plus R to the power of T. And this is the 1 year. So basically, we have 1 1,470, which is the same thing as we calculated last time. So $1,470 is actually higher than 1,400. And first of all, we see the price difference, and therefore we know that there exists a arbitrage opportunity. So our conclusion from this calculation is yes, we have the arbitrage opportunity. When you see an arbitrage opportunity as a price difference, now what we need to do is to work out the strategy in order to lock in the profit. And the arbitrage strategy would include the offsetting position. So basically, when you buy something, you have to sell something at the same time. And the principle of locking arbitrage opportunity is to buy low and sell high. Okay, whatever is lower, we buy in. Whatever is higher, we sell out. So looking at the forward price, it is lower than what is supposed to be given the time value of money of the spot price. So what do you do? What do? We long forward. Is that we buy the forward contract?
Yes.
Yes. Okay. So I just take a note over here for you. So our strategy. Our strategies would be at t equal to 0. Which is at present would be we long F okay, and the opposite would be to so we long forward contract of gold, and then we
Sell.
Short the spot.
Short.
we sell gold, right? Short and sell, short and long is applied for the derivative contract only. When it is product, we use the normal word. So we sell gold. Where do we get the gold to sell? Where do we get the gold to sell?
We borrow from others.
If it is possible, you can lease gold. The word is lease. Lease is like you borrow gold and then you sell gold. So obviously it incur some of the fee for leasing gold, but suppose that we ignore it at the moment. We lease gold and then sell it to the market at the price of how much? So long F at 1,400. We sell gold at 1,400. Is that right?
Yes.
Okay. And then when we lease gold and sell, what we get is the money. We receive the money. So we invest or we deposit. Okay. We don't leave the money idle. We invest 1,400 or 1,400 at the, supposedly we invested at 5% of the interest rate. So this is the current strategy that we are going to do at the moment. Okay. Okay, 1 year later, what would happen? One year later, we withdraw the money. Is that right? So we withdraw how much?
1,470.
1,470. Very good. Then we exercise for what contract? Is that right?
Yes.
We exercise F at 1,400. So the difference would be 70. Okay. So suppose that even if we have to pay a certain amount for leasing gold, let's say $10, then we still have 60 in the end as the profit. Okay. So this is how we do when you see an arbitrage opportunity. You have to work out the strategies as long as we have to calculate the let's say what we will achieve after taking the strategies, after undertaking the strategies. Okay. So basically, this is what we have done. We basically consider the spot price with the time value of money. So F would be equal to S plus 1, S multiplied by 1 plus R to the power of T. And the R would be usually, it could be the interest rate, the risk-free rate, if it is a currency, domestic currency, or any kind of rate offered to us. And in our example, what we did was to calculate in the same formula to see, supposingly the spot price will grow into after a period of time to a certain value, and we compare the value with the forward price given in the forward contract. And if there is a difference, we conclude that there is an arbitrage opportunity, and the principle of locking in the arbitrage profit is to buy low at a lower price and sell at a higher price. And therefore, after a certain period of time, we would be able to lock in profit. Okay, try this. Now we change to a different product. So instead of considering gold, now we move on with the oil. And oil is supposed to be, if you keep it, you have to pay certain cost for storage. Therefore, it incurs what is called storage cost of oil, and it is listed at 2% per annum. So if the spot price of oil is $95 per barrel, and the future price of oil is $125, the interest rate is the same as 5 years. Now, is there an arbitrage opportunity?
There is an arbitrage opportunity in here.
Okay.
You would short the future at $125 and you buy oil at 95. The price of the future of oil, it should be that 95 times 1 plus 7%. The 7% is obtained from the 5% plus 2%, and it would be 101.65. In 1 year, you would obtain, in 1 year, if you short the future at 125, buy oil at 95, the return that you will obtain after 1 year is 125 minus 101.65 it will equals 23.35.
23.35. And your name is?
My name is Tammy.
Tammy, okay. Yeah, Tammy is very quick in calculation. Do you agree with me? You work out the same solution as me or different solution?
I had the same solution.
Same solution, okay. So what do we do is similar to what we explained in the gold situation, right? Now, with this spot price, we calculate applying the interest rate and time value of money, then the F would be equal to 95 multiplied by 1.05 to the power of 1. So this would be equal to 90 what? 99? 99.75, right? Okay, so if we compare 99.75 with 125, we see the price difference. Therefore, whenever there exists price difference, we conclude that there exists arbitrage opportunity. So there is arbitrage opportunity, right? Now, as arbitrage opportunity exists, we know we buy low, we sell high. The future price is actually high, so what we do?
And
Short.
We
short
short.
contract.
Okay, we short future at 125. What else? We buy oil.
Buy oil at the spot price.
We buy oil at 95. How do we get the money?
We borrow $95.
Okay,
Interest rate of 5%.
we borrow $95. We borrow $95. Okay, now when you buy oil, right, you have to think about where you put it. Therefore, it incurs the cost of storage, right? And probably you'll be requested to pay it at the beginning or at the end of the period, right? At the end of the period or at the beginning of the period. So it depends on the situation that, okay, if it requested you to pay at the beginning of the period, then 2% of $95 will be paid today. And therefore, you will have to borrow more than $95. Okay? If you are supposed to pay the storage cost at the end, probably you will get the money from selling the oil at the same time as paying the cost of storage. So probably you don't have to borrow it from today. Or sometimes you have to decide, whether to borrow at the beginning or borrow at the end, or, sometimes you have to pay in the middle of the period. For example, if it is a year, but it requested you to pay after 6 months, for example, then it depending on the situation, then you have to work out the certain amount of money and the best way of using your money. So probably you will borrow you know, for 6 months, or if you have free money, you put it into the bank account for it to grow a certain interest rate after a certain period of time. So suppose we put it in the simplest situation in this example, then we leave it till the end to pay for the storage cost. Then probably at the moment we don't have to borrow for the storage cost to pay upfront, and wait until the contract expires. Then we would have to pay the storage cost. Then we ignore it at the moment, right? So 1 year later, this is the strategies that we are going to do today at T0. Okay, so I don't write in the very constructive way as before, because it takes more time. So 1 year later, what we would do is to, first of all, exercise the future contract, right? So we exercise F to receive 125. Now we pay back debt. How much? We pay debt that we borrow at T0 equal to 0 at, is that 99.75? Yeah. And how much is the storage cost that we have to pay?
$1.9.
Storage cost as $1.9. So totally, the leftover will be 23, right? 0.35 as me calculated. $23.35. Yes. Very good. So this is easy. You catching up with us, all of you, or if you don't understand anything, please raise your questions. Okay. Let's move to another case with the same product as oil. Now we have the same thing, right? Spot price, but the quoted 1 year future price of oil is now 80. What is your conclusion? Is there an arbitrage opportunity? What's your strategy?
I think there's an arbitrage opportunity because the future price is 95.75 as we have calculated. And I think the strategy must be we enter for today. We will enter the long forward at 80, and we sell the oil at 80, and we invest 80 at $5. At $5.
Which one?
Invest 95.
95.
Sorry. Yeah, 95. And then 1 year later, we can withdraw the money, which is, as you calculated, 99.75 in the future. And then we exercise the forward contract, which is 80, and then we pay the storage cost, which is 0.9.
Okay. Do we have to pay the storage cost?
Oh, no. Yeah. I'm
No,
sorry.
right?
No. Yeah.
Because actually we are not holding oil. We do not have oil in hand, right?
Yes.
Can I ask who's speaking?
It's Đức Anh.
Oh, Đức Anh. Okay. Yeah. Totally agree. But in case you do not have oil, what should you do? If you do, your solution, your strategy is to long future contract at 80 and we sell oil at 95. What if we don't have oil?
I think we must buy it.
We buy and then we sell? It
No,
doesn't make sense.
we lease it.
We lease? But if leasing is not possible, what should we do?
I have no idea now.
Okay, you should borrow from your parents. Okay, for this strategy, we have to identify different options, as if leasing is not possible, then only those who have the oil, right? Those who have oil or those who own oil will be able to carry out the strategy, as Đức Anh said. But the same mechanism is applied when we see the price difference. We conclude that there exists an arbitrage opportunity, and the principle is to buy low and sell high. So whatever is lower, we buy in. Whatever is higher, we sell out. And it must go together. Buy and sell must go together. And the way you lock in profit would be similar, right? So Đức Anh, suppose that you could carry out that strategy. The final profit you can lock in would be how much?
Let me calculate.
Okay. Anyone finished calculating? You can tell the whole class.
So it's 19.75.
19.75.
Yeah.
Is that the same answer with all of you, guys?
Yes, I do.
Same to me. Anyone else? Just me and Đức Anh are in the class. The rest of you are taking a nap. Try to do it yourself, okay? And when you listen, you seem, to understand everything we discuss. But when it comes to your own facing the question, you may not be familiar with what we are doing. So try to solve it as long as we move slowly. Otherwise, when we move to the next part, then it would be very difficult for you to catch up. This is simple example. After that, as we move on, more complicated situations will appear, and once you have the skills, your reaction to each situation will be faster and more precise. Okay, so now we move on with another type of derivative contract, and in this case we mention the options contract. Okay, now an option is defined as a contract. A contract. Wait a minute. That indicates the right. So the right is underlined over here to magnify this word. This is the right, not the obligation. the right to buy or sell an asset. So we may have two types of contracts. The call option, which is the option to buy a certain asset by a certain date for a certain price. And this is called the strike price or the exercise price. Okay, but strike price is more applied for option. Exercise price is more applied for forward futures. So a put option on the opposite is the option to sell a certain asset at a certain date for a certain price, strike price. Okay, so we have two types of option depending on whether it gives the buyer the right to buy or to sell a certain underlying asset. And remember, it is called option because it gives the holder the right, the option to exercise it or not. Okay, so we are given the decision of whether or not to decide to exercise it at the maturity date. So we have the option to opt out when we don't think it is suitable to exercise the option. Okay, so when we buy the option, so let's say when we buy the option, we are having the long position. We are in the long position, right? When we sell the option, we are in the short position. Okay, so now we have two positions with two types of option. We may long a call or long a put, or we short a call and short a put. So long a call means we buy the right to buy. Short a call means we sell the right to buy. If we long a put, we buy the right to sell. And if we short a put, we sell the right to sell. Okay. Remember, the very important thing in this is if you are in the long position of whether or not it is a call option or a put option, you have the right to exercise the option. But if you are in the opposite position, if you are in a short position, if you are selling the option, whether it is a call option or a put option, you have to be dependent on the decision of the call option, the long position person, or we call it the holder of the option, okay, to decide whether to exercise the option. So what you expect to do if you are in a short position of the option contract is to collect the premium. Okay, this is called the premium or the fee of the contract. So the seller of the option is also known as the writer of the option, and the buyer of the option is called the holder of the option. And always bear in mind that the holder of the option is the one that's given the right to exercise the option. The writer of the option is the one who only collects the premium, the option fee. Okay, so that is what you need to do. So we can long a call, so we buy the right to buy a certain asset, or we long a put, we buy the right to sell. If we short a put, we sell the right to sell. And if we short a call, we sell the right to buy. Okay, is it clear to all of you?
Yes.
Yes, okay, don't be confused. It is confusing a little bit, but as long as you get used to it, you memorize the situation, then it could be not that confusing anymore, hopefully, yeah. Besides the call option and the put option, we would have two types of option depending on the ability to exercise the option, and we call it an American option and a European option. Okay, American or European does not relate to the geography. It does not mean that American option is only traded in America. No. Or European option is traded in European countries. No, it only identify the way that you can exercise the option during its maturity, during its life. So American option can be exercised any time during its life until maturity, but European option can only be exercised at the maturity. Okay. So you have to remember this part, this feature of American option and European option. So European option is easier to be valued because we have the fixed period of time. But for American option, it may be more complicated to value its value over time because it gives the holder the flexibility of deciding when to exercise the option. This is the example just for you to see, you know, like for example, we have Google call option prices listed on the Chicago Board of Exchange for different periods, the bid offer, the bid and offer price and the strike price for different period of time, or the Google put option prices listed on the exchange, as you can see. So basically, if we compare the features of options, futures, and forwards, as you can see, future and forwards gives the holder the obligation. Okay, so obligation means that once we sign the contract, we are obliged to carry out the contract. Right? There is no way that we can opt out. Okay, so it is the obligation to buy and sell a certain underlying asset at a certain price at a certain period of time. On the opposite, the two forwards and futures, an option gives the holder the right to buy and sell at a certain price at a certain time. So the holder of the option is not obliged to exercise it. The holder can opt out when the option is expired or during the option life. If it is the American option, but the holder has the right to decide whether or not to exercise it. The writer of the option would have to decide, based on the decision made by the holder of the option, and will have to follow the decision made by the holder of the option. What they want to do is just to collect the premium, and we will analyze it in the next few slides. Those traders who get involved in option trading or in derivative markets would be hedger. You know, hedger use derivatives to reduce risk from potential future markets movement, right? Obviously, we know that there is no guarantee that the outcome of hedging will be better than the outcome without hedging. But normally, when we talk about hedging or hedgers, they normally possess the assets and they want to hedge the risk of price movement in the market. Another trader that get involved in derivative trading is speculator. And speculator is more like betting. When you want to bet on the price movement or the future direction of the market variable, then you enter the market as a speculator. So either the speculator can win a lot or can lose a lot as well if he loses, right? An arbitrager, on the other hand, as you can see, they aim at the price difference of the market, probably quoted by different market makers. and they want to lock in profit by entering the market with the offsetting positions. As we have done several examples before, you understand how arbitrage opportunity exists and the strategies related to arbitrage opportunity. Okay, now in order to understand how these traders get involved in the market, now we would take a look at this example and identify different situations, and you can improve your understanding about different type of traders entering the derivative market. So suppose that we have the US company that will pay 10 million pounds for imports from Britain in 3 months and decides to hedge along with using a long position in a forward contract, right? Or an investor who owns, like, for example, 1,000 shares of Microsoft, and the current price for the share is 28. Now he enter a 2-month put with a strike price of 27.5 that costs $1 as the premium for the put option, and he decides to hedge by using, let's say, by buying 10 contracts. Okay, so these are probably the examples. Now try, if you look at this and try to work out the situation. In this case, probably we start at the second one, just to save time. Now this one. Now tell me, how can he, if this investor that owns 1,000 Microsoft shares and he enter a long position to buy a 2-month put contract, put option with a strike price of 27.50, and it costs $1 per put contract, and he buys 10, $1 per share in a put, and he buy 10 contracts. Usually one contract will contain about 100 shares. One contract contains 100 shares. So 10 contract will contain 1,000 shares. Now please work out the situation.
Can I answer this question?
Okay.
So I think that there will be 2 scenarios. The first will be if the stock price will increase more than 27.5, then the holder will not exercise the right of the contract. So he will lose the premium fee of 1,000. And the second case is if the stock price decrease, then the holder will exercise the contract, and then he will gain 27,500. But if and then we will minus the premium fee of 1,000, and the final profit will be 26,500.
So when the price increases or decreases, then it will be beneficiary for this investor.
When the price decrease, it will benefit the investor.
Okay, thank you. Who's saying?
My name is Chang Nhung.
Okay, Chang Nhung. Do we agree with Chang Nhung, or do you have different solution? Do you agree with Chang Nhung?
I think yes.
Yeah. Okay, so basically, in order to understand this situation more, first of all, we need to see this person has the 1,000 shares, and he decided to enter the long position of the put option. So when you long put option, what's your expectation? You long put option, it means you buy the right to sell.
To decrease.
Right? You buy the right to sell. What's your expectation?
We expect the price to go down.
Decrease.
We expect the price to go down or to decrease, right? And we hedge against the what? The what? Against the if the price decrease, then you exercise the option. Yes or no? If the price decreases, we exercise or not exercise the option?
We exercise the option.
We exercise the option. But if the price increases, then
You will not exercise.
We do
the
not
option.
exercise.
We will not exercise.
We do not exercise the option. We opt out, right? We opt out. Okay, so in this case, when do you think this person, this investor, will exercise the option?
I think when the price fall below 27.5.
Below the strike price, then the investor decide to exercise the option. When it grow above 27.5, then what would happen?
So I think the investor will not exercise the option.
Okay, he will not exercise the option because then he would have to sell at the lower price than the market price. Then obviously he just go to the market and sell it, right? It does not make sense if he exercise the put option at the lower price than the market price. Then he would let the option, the put option, expire worthless, right? Or he opt out. Okay. And what will he lose in this case if he let the option expire worthless?
Premium.
We lose the premium.
The option premium. And in this case, it is how much?
Is $1 multiplied with $1,000
$1
share,
per share,
and it's
so
$1,000.
$1,000.
Okay. Right. So if we take a look at this, very good. It compares between hedging and no hedging, right, situation. So basically, the owner of the share is hedging, against the price reduction. So basically, we would have this line go like this, and if there is no hedging, then if the situation would be we cannot manage the situation where the price is decreasing over time. Okay, now we move on. That is about hedging, right? Basically, when it comes to hedging, we would have to have the possession of the asset, and we want to lock in the price movement in a certain position, whether it is increasing or decreasing, depending on each position that we enter into the derivative contract. Now let's move on with the speculation example to see, okay, when we enter the market as the speculator, then what possible outcomes can we get as a speculator entering the trading? Now, an investor with $2,000 to invest feels that the stock price will increase over the next 2 months. The current stock price is $20, and the price of a 2-month call option with a strike price of 22.50 is $1. Now, tell me, what can be alternative strategies in this case?
I think there would be 2 different strategies.
Mm-hmm.
The first strategy is that the investor can purchase 100 shares, and the other strategy is that he can enter the contract.
Yes.
The call option, and exercise the call option.
He buy or sell?
He sell the price. In this case, is it a long call? Long call
option?
Yes.
Mm-hmm.
But if he enter the call option, if the price
So Long is trying to say that we have 2 strategies. One is to buy. 2 way of doing this is to buy how many shares?
In this case, it is 100 shares.
Okay, first one, 100 shares, buying 100 shares, right? And second?
He enters the call option.
How many call option?
20.
20? 20 contract?
Yes.
Okay. Is that 20 say 20 contracts, right? Yes. Okay. So what would be happening next?
There would be 2 scenarios. The first scenario is the price going up.
Mm-hmm. So up and down.
Yes.
Okay, let's say now 20, if we go up, we go to 20, what? Let's say 28.
Yes.
And if it goes down, it goes to how much?
18, for example.
Let's make it more severe. Let's say
15.
15, yes, okay. Okay, now 2 cases. 28. Oh, sorry, 28. And 15. Okay. Now, if you own 100 shares, if the price increases to 28, yeah,
Yes.
then you make a loss or a loss or a gain.
You will make a gain of 28 minus 20 and multiply by 100.
Okay. And it would be 100 shares, $800. And if we make a loss?
The loss would be 100 times 15 minus 20, and it is minus 500.
Okay. Okay, what about option? If the price increases to 28, will you exercise the option?
Yes.
Why?
Because we are in the call option, so make a profit if the price goes up.
Yeah, when we enter the long position in a call option, our expectation is to have the price to go up or down.
If we enter the call option, we'll expect the price to go up.
To go up because
we can purchase with a lower price rather than the higher price in the market.
That's right. Okay, so we have 28 minus
28 minus 20 and
20. Are you sure?
22.5.
22.5, yes. And then we multiply with
2,000.
2,000 shares and
minus the premium.
That's right. We minus the premium of how much?
Of 2,000.
2,000. So what is your final profit?
It is 9,000.
9,000. Okay. What about the other case? 15. Now we have.
In this case, the price go down, so the investor will not exercise the call option, and he will lose the premium fee.
That's right.
2,000.
Okay, so the maximum loss is 2,000. Right? Because basically we have the option to opt out, to let the option expire worthless. So the maximum loss is 2,000 in this case. So what do you think? If it is a speculation example, if we compare between gain and loss, right? With the option of buying 100 shares. So in this case, we can see if we make a gain, right, it would be much higher than a gain if we buy the asset directly. But when it comes to losing, right, obviously it is much higher than the case where we buy the asset directly rather than entering the derivative contract. So either we can gain a lot or lose a lot at the same time if the result does not turn out to be what we expect. Okay, arbitrage opportunity. Now we have done several examples related to arbitrage opportunity already. Now you are very familiar with what we should do. Then with this one, just help me to calculate this. Is there an arbitrage opportunity? And if there is, what should we do?
There is an arbitrage opportunity in this case. So you would buy 100. You would buy 150 in New York and you sell it at London at the rate of 155. So you would gain 15,300 minus 15,000, and you will gain $300.
$300. Yeah. As you can see, 100 and 150 in New York. So it is like one exchange for 150. Sorry, 1.5. Now the current exchange rate is actually different, right? 1.53. So we can see the price difference, then we see the arbitrage opportunity, and we buy low. We buy low at we buy 100 shares at the price of we buy in New York, right? And then we sell them in London with the exchange rate. Then we get the higher rate. So $300. Do you share the same result with me? Is the lock-in profit if we exercise that strategy? Yes or no? You share the same result, $300.
How many stocks do we buy?
We, well, just assume one stock. I would still like say 100 stocks. 100 stocks. You can have your own assumption. It can be more than that if you. It depends on your assumption, but probably the difference is 3, right? Over here. So we multiply with the number of stocks that you assume to buy. If it's 100, then you have 300 as the gain. If it is 1,000, then you have 3,000 as the final result. Okay. There is a danger in the market that you know, the traders can easily switch from being a hedger to a speculator, or from being an arbitrager to a speculator. And sometimes as the market maker, it's very important to control this, because they don't want the traders to end up with not with their intended purpose. And you can look into the business snapshot 1.2 for further details to see the danger of switching from one position to another position. We also come across with the definition of hedge funds, and hedge funds are not subject to the same rules as the mutual funds, and they usually cannot offer their security publicly. And we also have the form of, we identify the hedge fund differently from mutual fund. So mutual fund must disclose their investment policy and make shares redeemable at any time. And they have their certain regulation for leverage using. But hedge funds are not subject to the constraints given to the mutual funds. Hedge funds can use more complex trading strategies, and you know, they are a big user of derivatives for hedging, speculating, and arbitrage. You can also see a lot of hedge funds with different products. So basically, this is just to provide some extra information about the difference between hedge fund and mutual funds. That is the end of chapter 1. This very simple chapter that we have just been studying together, and we end up with the picture there describing the situation when we enter the derivative trading. Right? Sometimes we get very confused of whether to buy or sell, and whether to make the strategy of buy this or sell that, buy this or sell that, sell this, right? It can be a madness for sometimes. Okay, do you have any questions related to this chapter? Any questions related to this chapter? Oh, Tung Bak, you are in the same class, in this class?
Yeah, yes.
So is this our class? I mean, the class as I used to be the form teacher.
Yes.
So we have the majority of the class studying in this course.
Yes, our class is almost, I think.
Almost. Okay. Very glad to see all of you in person. Hopefully, I can guide you through this course successfully with very good results. And no one is left behind. Okay, I think you want to take a break or we can move on.
Maybe take
I
a
think
break.
a break would be nice.
Okay. Okay, a short break for you to refresh yourself and I will see you in a bit. Okay. Let's say we'll be back at about 4:30. Okay, let's come back. You know, today is Friday the 13th. Supposed to be a terrible day, right? How is your day going on? With a lock-in situation like this, then nothing is not that unlucky that could happen, right? Okay, hopefully that you stay safe, you find a way to enjoy yourself at home, probably develop a new hobby and spend more time reading and studying, spend time for financial risk management. Okay, I think we can get started with chapter 2 a little bit, and if we don't finish it today, then we can leave it to next week. Next week we will have a practice section together for both chapters. Okay. Chapter 2 will be about the mechanics of future markets. So basically, in this chapter, it would be we will be explained in more details about how the future exchange would be operated. As you can see, futures are different from forward contracts in a way that it is traded on an exchange. So future contracts are available in a wide range of assets. Supposedly, in Vietnam, we only have VN30 and the government bond, but this is only for corporate businesses. But in the world, we have a wide range of different assets, underlying assets embedded in the future contracts. And we remember that future contracts are exchange traded, right? So by saying it is being traded on the exchange, we understand that we can limit the credit risk, the risk of not paying between one side to the other side. And also all the contracts will be set as a standardized contract. So if we want to get involved in trading, we may buy one contract, two contracts, or etc. Specification will need to be defined in each contract, and these contracts will be standardized, and the specifications include what can be delivered in the contract, where it can be delivered, and the time when it can be delivered. And one thing that we need to remember for is a very standout point of a future contract. It is the daily settlement, or we can say it is settled daily. And what does it mean by daily settlement? I will explain in the next few slides. Okay, looking at this graph, you may see this is the tendency in which we call there is a tendency of the conversion of prices from future to spot. And how do we understand in this situation? So when we enter the contract, right, the contract, the future contract, even if you can see the difference between the spot price and the future price, But as long as we move on with the lifetime of the contract, right? When we reach the maturity, let's say, or the certain period of time in the future, there would be a tendency of the conversion of the future price to spot price. And if the spot price is lower at the moment in comparison with the future price, at a certain point of time in the future, these two prices will tend to converge to each other, and vice versa. If the future price is lower than the spot price, then at a certain point of time in the future, there would be a tendency of these two prices converge to one another. Okay, that is how to explain for conversion of futures to spot. For future contracts, what you need to understand the mechanism of how future market operates, then we come across to the definition of what is called a margin cash flow. Okay, and how do we differentiate between these cash flows? Now, the trader, when he wants to enter the market, right, then what he is required to put into his account is what is called, he has to have a margin account, and he has to deposit what is called the initial margin. Okay, so let's say this is like a condition for any trader to get involved, to get started trading in the future market. He has to open an account, and it is called a margin account. And initially, he would have to deposit into the margin account what is called the initial margin. And this initial margin will be dependent on different contracts and the requirement of the initial margin that he would have to be required to deposit. If he buys, let's say, one contract, he would have to deposit, say, $6,000, or two contracts, then he multiply by two, $1,200 into the margin account, for example. And the mechanism of working out the margin account, because the mechanism of the future contract is settled daily, which means at the end of the day, the trader will know whether he's making a loss or making a profit, and a loss will be deducted into the margin account, right? Profit will be added for certain. But whenever the initial margin falls below the maintenance margin, okay, we have what is called the maintenance margin. So it is required, like whenever it goes below the certain maintenance margin, then the clearing house, we call the exchange clearing house, would have to issue what is called the margin call. The margin call is like a request for the trader to top up their margin account up to the initial margin, so that the transactions for the next day would be going on. Okay, so if the trader does not fulfill the request by the clearing house, then his account will be closed and no more transaction. Or we can understand that he decides to close out his position, and the next day he won't be able to continue the transaction, to continue the trading, because he has not topped up his account up to the initial margin. That is for the trader. Okay, now we also have what is called the member of the clearing house. Okay, what's the difference between the trader and the member? The member of the clearing house, exchange clearing house. Remember last time when we talked about Vietnam derivative markets, and we talked about the future market that has just been established recently in 2017, and we talked initially there are 7 security companies working as the clearing house member. If you remember, if I recall you to what we studied last time. So they are, you can understand as they are like the middleman to connect between trader. Below them, there would be brokers, and then traders. So they are like those who will connect the traders, the brokers, the traders, with the exchange. So the member also is required to have what is called initial margin. Okay, initial margin, that it is like the margin that he deposit to the exchange clearinghouse to make sure that they fulfill their task, and they will this margin adds liquidity to the exchange. And the difference between the member margin account and the trader margin account lies in the way that for the trader, it requires the initial margin together with the maintenance margin. But for the member of the clearinghouse, the exchange clearinghouse, they have to maintain the initial margin only. Okay, they do not have the maintenance margin. So every day, after the end of the at the end of the day, the member of the exchange clearinghouse is requested to top up their margin account back to the initial margin. Okay, so we understand that even they don't have the maintenance margin, but the initial margin is like the maintenance margin level as well. And this daily margin cash flow is referred to as the as what is called the variation margin. And the member of the clearinghouse is also required to contribute to the default fund. This is to make sure that the market has liquidity, and every transaction will go on normally during the period. Okay. Now, a margin can be deposited in the form of cash or marketable securities, and the investors will have to deposit it with his broker, his or her broker, and the broker is the layer before, how to say it, is above the trader, and the broker is the middleman between trader and clearinghouse member. And then we have the central exchange. I'll show you the graph in a few minutes. And the balance in the margin account is adjusted to reflect daily settlement. Okay, so all transactions will be reflected through the margin account, and whether you have made a gain or a loss will also be adjusted daily. Okay, margins minimize the possibility of loss through a default on a contract. So basically, this guarantee that the liquidity of the market is guaranteed through margin account. Okay, let's take a look at this example to see how what does it mean by daily settlement, and what does it mean by initial margin, maintenance margin, and margin call. Now, an investor take a long position, so he buy, right? Long position in two. Two means two contract. December gold future on June the 5th. So this is the starting date when he enters the trading in the future market. Now he takes two contracts. The contract size is 100 OZ, which is ounce for gold, the measurement unit. The future price started when he signed the contract, when he entered the contract, is 1,450. Okay, and the initial margin requirement is $6,000 per contract. As he buy two contracts, so the initial margin is 6,000 multiplied by 2, and then it is 12,000. Right? Now the exchange requires that these investors must maintain a margin at 4,500 per contract, and since he has two contracts, so it is 9,000. So 9,000 is the maintenance margin. Initial margin 12,000, maintenance margin 9,000. Okay? Is it clear?
Yes.
Yes, all right. Now, this could be to demonstrate what is going on if he enter the contract. So we have day one. He starts at the price of 1,450. Now at the end of day one, the market price, right, the settle price is 1,441. So the price drops. Okay, it's settled daily. It means that every day that the price will be settled at a certain price, and the margin account will be adjusted accordingly to reflect what is going on in the market. So this is a daily gain or loss. How do as you can see, we have over here minus 1,800. How do we achieve this number? Because the price drops and he is in the long position, right? So he's making a loss. But how can we achieve the 1,800?
You have two contracts,
Multiply by 100.
and you have minus 1,401 minus 1,450 times two contract plus times with the contract short size is 100, and you have the 1,800 loss.
Okay, so it's a loss, right? It's a loss because the price drops. Like at the beginning of day one and at the end of day one. Then, as you can see, it will reflect in the accumulated gain or loss of the account. And we have to adjust what is called the margin balance, the margin account. It reduced by 1,800 to 10,200. Day two, the price continues to drop, and we continue to make a loss of 540, accumulated loss 2,340. Margin balance goes down 9,660, and etc. Suppose on day 6, right, the price continues to drop. We still make a loss, and the margin balance goes down to this amount, which is closely to the maintenance amount. On day 7, after deducting the loss, then the margin balance goes down below the maintenance margin, right, which is 9,000, and therefore the exchange issue a margin call. This is the margin call. So it requests the trader to top up the margin balance to the initial margin, right? And etc. Day 8, day 7, day 6, 8, 9, etc. So this is how it looks on your margin balance. And supposingly that this trader does not satisfy the request, does not respond to the request of the margin call, then the exchange will terminate his transaction, or we say the exchange close out the position of this trader, and he will not be able to continue trading if he does not top up his account when he receives the margin call. Okay. Okay, so this is how we have the margin cash flow. So basically, we understand the clearinghouse as the exchange, and we would have the clearinghouse members working for the clearinghouse, and under we have broker, and we have short trader, long trader. When the price increase, this is the flow, the margin flow from the short trader to the long trader. And when the the price decreases, then this is the flow. So you understand different layers involving in the market. Okay. We also come across some terminology, for example, open interest. Open interest would be the total number of contracts outstanding, okay, in the market. It is equal to the number of long positions or a number of short positions outstanding in the market. We also have what is called the settlement price. The settlement price can be understood as the price just before the final bell of the day, right? And this settlement price is used for the daily settlement process. And as you can see, it is reflected through the adjusting margin account right over here. So the settle price is the price we calculate the gain or loss and reflected in the margin balance. Volume of trading, we understand it's as the number of trades in one day. So it reflects how much trading the traders get involved in the market. The key points that we have to remember about future contracts, that the first thing is it is settled daily, right? So it's unlike forwards contract that we have the end of the life of the contract that we understand whether we make a gain or loss. But now we for future contract we have the settle daily settlement price, okay, price daily settlement. And when you want to end the contract, normally you would have to close the contract by entering the offsetting trade. Okay, so if we are buying a future, if we long a future, we close the position by sell the future. Okay, and for future trading, most contracts are closed before maturity. Okay, because basically traders, when they get involved in future trading, they don't expect to exercise the contract. They don't want to deliver the asset. They just based on the underlying asset price movement to gain or to make profit, but they don't want to have the actual let's say products exchange. Okay, so this is how it looks when we see for example, crude oil trading. And so we have open price, high, low, prior to settle, last trade, change, and volume of trading, just to see the reference. Okay. Also, sometime, okay, I think the last part that would be covered in this future mechanism is the collateralization in the OTC market. Since for OTC market, in order to make sure that the people involved, the traders involved in the transaction in OTC market, to fulfill their obligation, it is now becoming very common for transactions to have collateralization. So, for example, if we consider the transaction between two companies, A and B, and normally let's say the party that govern the transaction between A and B would be the ISDA master agreement with the credit support annex, and normally they would act as as the middleman to require the company A to post the collateral with company B, and this collateral will be, the value of the collateral will be equal to the outstanding transaction between A and B when the value of the transaction is supposed to be positive. So if any case A defaults, then B would be entitled to take the possession of the collateral. Okay, and this transaction, the transactions in the OTC obviously are not settled daily, right? And if the cash is deposited as a collateral between the two parties, then obviously it will incur the interest rate on cash collateral. Okay, so traditionally, as you can see, most transactions have been cleared bilaterally over the OTC. Right? But after the crisis, there has been the requirement that the OTC market also have to enhance its transparency and to make sure that all the transactions would guarantee the possibility of default of people, of traders getting involved. Therefore, the requirement has been tightened, and most of the derivative transactions are cleared through what is called the CCP, right? And the CCP acts similarly like the exchange, and it also requires initial margin, variation margin, and default fund contribution to the members, similarly to how the exchange clearinghouse operates, as you can see. This graph shows you the bilateral clearinghouse and the central clearinghouse. If you take a look at this, then obviously, as you can see, this is the central clearinghouse. While bilateral meaning we work together, two parties, like bilaterally. Looks more complicated in this bilateral clearinghouse rather than the central clearinghouse. Right. Okay. So new regulation for trades between traders that are not cleared centrally is that we require the dealers to post both initial margin and daily variation margin. And the initial margin is posted with a third party, right, for the OTC. Okay, regarding delivery, if the future contract is not closed out before maturity, it is usually settled by delivering the assets, the underlying assets of the contract. Right? So normally, most of the transactions will be closed before the maturity because we understand that the traders getting involved in the future market would not want to come up with the final state of delivering the assets. But in the exceptional case, when the contract is not closed out before maturity, then we understand that the two parties agree that they will deliver the underlying asset written in the contract. And when there are different options of what to deliver, where to deliver, and when to deliver, then in this case, the party with the short position will choose. Okay, is opposite to option. The decision would be in the hand of a short party. A few contracts, for example, like stock indexes or euro dollars, will be settled in cash. That is what we need to bear in mind. Okay. Now we have a questions over here, and I want you to answer. Is when new trades are completed, what are the possible effects on the open interest? And can the volume of trading be greater than the open interest? I will leave the two questions here for you to go home and think about it and give me the answers the next day, next week. The next section we see each other again. So do you have any questions related to how future market is operated? I think there is one thing I need to verify. Okay, margins over here can be deposited to the investors by the investors to his broker by cash or marketable securities. So you can deposit by your stock as well. Okay, so either if it is cash, it's 100% of the cash value. But if it is marketable securities, then it depends on the regulation set by the exchange. Then it could be 70. It could be calculated as 75 or 50% of the market securities, the value based on the market price of the securities. Yeah. Do you have any questions so far? Understand the mechanism? Anything difficult that you want to ask me for more clarification? No? You're so quiet. No question?
I think no.
Okay. So yeah, okay. Now, if you don't understand anything, please ask, okay? Because it's very difficult for me to know whether you understand, because we don't study offline. When I look at your face, I would understand whether you understand it or not. But since we are studying online, so you have to be very active in approaching me. Otherwise, it will be difficult for you to follow the whole course. This is what we don't want, since the situation of COVID is getting very serious. So we have to study online like this. Hopefully we'll be able to see each other soon. Okay, if you don't have any question, then